Welcome to the REI Foundation Podcast, where we cover all the steps and strategies to make your real estate dreams a reality. Now your hosts, Jason and Peely.
Well, welcome again to another edition of the Real Estate Investing Foundation Podcast. It is Monday, and with Monday, we bring you everything that has to do with multifamily. But today, we are very excited. And I will say we, as in me, myself, because Peely's out there doing all things that power women do and taking care of the little ones. But I do have Dino Pierce of Edified Equity today, and we have a very awesome story we're going to bring to the table. So, Dino, welcome. Please give us a little more feedback and guidance on who you are.
Well, thank you. I appreciate it. Thanks for having me here. So now I am your partner.
Absolutely. Congratulations to me, because it's been an awesome partnership, and congratulations to all of us and all of our partners.
Yes. All of the equity partners, GPs, it's just a phenomenal opportunity. But a little bit of background on me. I've been investing in real estate for a little bit over 4 years. Have some single family fix and flips. Not that I ever ran a crew, but what I would do is find a great opportunity, would market direct to sellers, then bring in someone who had that knowledge and wisdom to actually see the project through fruition, and we would partner. And I might even lend a little bit of the money, part of the fix up, and we would kind of settle things on the back end. I did that for about 3 years. And I would say 2.5 years into it, I had a good friend who was COO of a large apartment community acquisition company. And he kept telling me, man, you're doing great in business. I also run a medical device business. You're doing great on your medical device side. You're killing it with the single family and the private money lending. But he's like, I know you have to be getting killed on taxes, and you should really look into apartment syndication. So I did. And I probably took the first better part of 8 months to really just learn the business. And I was taking action at the same time, networking with brokers, trying to find deals. And 11 months later, I was able to close on my first syndication. So it was a process, but now I'm in and there's no looking back. I love it. I like the impact that we do. I'm sure we're going to talk more about that, but I like being able to, alongside the financial gain and the phenomenal tax benefits that go along with this alternative investment, what I love is helping people have a safe, affordable place to live, because I believe that the space that we're in is a basic human need that's always going to be there no matter what the market does. And I like being part of a company that provides that.
That's awesome. And one thing to note is that here's where I guess the rubber meets the road, right? You were having a good issue. You're having tax hits because you're doing well, and someone suggests you of an opportunity that you could go out and research and that may help you in this. But instead of just saying thank you for that, you went out there and researched, understood the opportunity, understood the viability of the opportunity, took action, and then within 11 months made it happen. So the quick thing there is this can happen quickly. 11 months doesn't sound quick, but if you think about what just happened in the last 12, 24 months, how quick that flew by, think about how much you did. And that, congratulations to you. So we are here today with Dino, and Dino and I first met. We actually met in Denver and at a convention or a conference, and then happened that we both were brought into an investment that we were both thinking about partnering on, and we decided it wasn't quite the right opportunity for us. We were not the lead on the opportunity. And then when we did have another opportunity out there, we decided to partner up together, and we're very excited about this opportunity we just closed on as of now, about a week and a half ago in Louisville, Kentucky, our bread and butter, right in the south side of Louisville.
Yes.
So
thank you.
A couple things. First is we always talk about market, because market is very important to us. And from that part, Dino, what do you think coming into Louisville? I know this is your first foray into Louisville. What were some of the things that really stood out to you about the market?
Well, what stood out was that it was in the open. So I've had a lot of the LPs that came in or were interested from my side, that they wanted to do the research, and everything we were able to provide or they were able to pull up on their own showed that this is the place to be. I mean, and even though we had found a bit from a syndication expert saying that Louisville was one of the top 3 markets of 2018. So what we like is that
don't tell everybody that.
I know. But what we liked was
Yep.
the population was growing, the economy is growing, and it still has a ton of room to grow. So people want to live there, they're able to find jobs, and at the same time, it's growing, and it's the desirable place to be. I know we looked at everything related to crime. We had a really, you guys in alignment with a phenomenal property management company, because the analogy that I always use is we're the coaches, but they're the quarterback. We're going to be guiding them along and telling them what plays to make, and on a monthly basis, looking at expenses and income line by line. But ultimately, I believe management can make or break an investment. So we had that there. And it was those two things, economy and market, and room for growth.
Correct. Yeah. And that was all the points you just hit on there. Also, construction starts were something that really stood out to us. There's not a lot of new projects coming online in this particular submarket in the foreseeable future. I think we have one about 2 years out. With that, from a building perspective, what really stood out, and we could talk about, finding the opportunity. This isn't our first opportunity in Louisville. It's not our only asset, but this was something that we found a long time ago. I mean, we're talking over a year ago, and this is where patience and persistence basically plays the course, is that we found this opportunity and we had negotiations with the seller, and we were close but no cigar, and that's fine. Went our separate ways. But what really sealed the deal here is that we consistently followed up, and with follow-up, that's where really you can find the ultimate decision to get to a closing. And that allowed us 12, 14, 15 months later for this deal that we found to get back into the mix and finally get this to the finish line. And what was really funny about this is that over that horizon, we basically stayed the course with our price, because this is just what worked for the opportunity. But the owner, or the prior owner, or just the past seller of the week ago, he actually did 2 rent bumps over this course of the last 12, 15 months. So although we were able to stay the course with our price guidance and get it there, he unknowingly raised the rents throughout that time. So we went back there and renegotiated with getting our price to the finish line. We actually came into a property that had now higher rents. Yeah. The great news there is that the rents, even though he raised them up some $50 per unit per month, are still almost $100 under market, even if we just walked right across the parking lot to a neighboring building. So ton of room to grow, ton of opportunity here. And it's been a very exciting foray back into Louisville. Yes. But let's talk about from this, for bringing you in as a partner. What did you see from the opportunity side beyond Louisville? What really do you like about this building, the submarket? What really stood out to you?
Yeah. Well, one of the things that I really liked was that it wasn't an experiment, although we were thrilled, because you can look at the research and know that if you find the right building at the right price, that Louisville is the right place to be. I know, hush, hush, but what I liked was that you already owned approximately 100 units not far from this area, and you already had a relationship with a property management company that you really liked. So when the underwriting took place, we weren't underwriting based off of projections. We're actually underwriting based off of performance. And that is huge, because again, we're not experimenting. If this can happen X miles down the road in the same market, we can do it here as well. So I really like that. And the other thing I liked about working with you and Kevin is you have a similar conservative nature. So we talked earlier when we first started, it was like, it took me 11 months to close on my first apartment community, but I had actually worked on 3 that never made it to closing, simply because we're in the same mindset. We're investors. We're not gamblers. So if it doesn't make sense and we can't come to an agreement while we're in contract in that due diligence period, we will walk. There's no reason to get involved in something. But with this, we had all the green lights. I mean, I remember working with an investor, and he was cold calling brokers off of LoopNet to find out more about the market. They were just really doing that. And one of them had a friend or a brother-in-law or something who was a surgeon out there, nothing to do with real estate. But it was a win-win, and it was hard to, we get under contract, we start trying to talk ourselves out of the deal, and we couldn't do it. So that was another reason. The conservative nature, having the relationship, having the track record already in the market made it a slam dunk of an opportunity.
Absolutely agree. And just for people out there, what also stood out to us is what got us first into this deal was that the prior deal we had purchased, the broker who was on the seller side knew that it's similar asset, that we like this opportunity, like these kind of opportunities. And so when he actually found this opportunity, he thought of us first and gave us the first run into it. So that's where doing what you say, saying what you do, and follow through, especially with brokers, definitely stands out. So continue to have broker conversations even at this time of stage of the market, because it definitely pans out. And for this, yeah, you're absolutely right. We're just going to rinse and repeat on our process, right? There's no new thoughts here. Just continue to do it. And for someone who doesn't have an asset yet, that's okay. You just have to do your homework. You have to talk to a number of different management companies, understand what's viable, understand what can actually happen within a market, so you can get down to the price of where your property is going to operate at. Because yeah, we talk about rent raises, that's great, but regardless of what our rent raises are, that's not an overnight process. There's leases, there's other perspectives. We want to keep an occupancy at a certain level, but we can start to work immediately on expenses and getting expenses under control. And if you can understand what you can do there, that can have almost or even more impact than your increases in rent and income. So from that perspective, do you want to talk about some of the day one plans with the building?
Well, I think, and you can correct me if I'm wrong, but I think one thing I want to touch on before we even jump into that, I don't want to lose this on my memory, is you're right. There's so much, like just how you got this kind of, it was like a pocket. It went right to you and Kevin first. Where we don't look at deals unless it comes from our management company or it comes from a broker that we've closed past deals on before. So once you get to that level, they know what you want and they know you're going to close. Like you say, do what you say what you do. It's going to come to you. Not initially, because you have to either prove yourself or align yourself with the people who have already proven that. But I think it's not like a major reposition. It's going to be basically upon natural turnover, slowly bump the rents, get them to where we need to be to target. And, we don't want to overkill so that people move out. But like I always say, the truth of the matter is, if you're at market or even slightly below, to keep that occupancy up there, I think that's a great way to run the business. Because if I go out shopping after the management company increases rent, or the owners, whoever, and I see that, wait a minute, I'm upset because they're increasing rent, but the truth is it's actually like $25 more a door for the same square footage across town. And, moving just doesn't make sense now. So maybe I thought differently, but then when I put the pencil to it, I understand what they're doing and why they're doing it.
Absolutely. And you're spot on, right? So we're going to go out there and basically just let the tenants know that we're there to make this building better. And that's as simple as they call for a maintenance request. Well, we go out there and fix it, instead of having an owner who prior was doing everything himself. And really, that's where it is. We have deferred maintenance on the building, and we also have a lack of management that we're going to be able to correct now. So we're going to go in there and put processes and systems in place, and then start basically repairing all the loose items. And that's where on a high level, that's where it can get very expensive. If you have little leaks here or there, well, that adds up for your water bill, especially if you are paying water. So we're going to go out in there. We're going to make sure we have any tub surrounds, any little leaks, we're going to address them immediately. We're also going to start working on our water savings plan, starts changing out toilets, aerators, faucets. And we've done this prior, it's cut down our water bill over 30%. So it's an astronomical way that we can just save on our bottom line. Past that, then we're going to start doing a rebranding on the building, a simple rebranding. There was a poor dilapidated sign out front, which was the only reference to this building. So we actually gave 3 different options for a name out to investors, and we're going to be renaming it. So everybody's very happy to go forward and have a new name with the building, new presence with the building. And that will give the tenants also an opportunity to see that there's going to be a new, better presence, and we want this to be a better community for everybody surrounded within the building.
Yeah.
So that's where we're at right now. It's just in the first stages. And the first stages is just Takeover happened just over a week ago. Bring Takeover letters into the tenants, start giving them the new directives of how we would like to operate, just to give them more clear position on how expectations will be and how we're going to make this place better for them. And then now having our maintenance staff come in, start answering the call, start fixing all the things in there. We want to do a few things with parking lots, laundry rooms, of course, getting cold with the weather. We'll wait for that for after summer. And then Linda required repairs will also be formatted within there that we'll start knocking out over the next 6 months. So very exciting time. We're super excited to see what we can do here. And I think this is really going to be another great investment for all of our partners involved.
Yeah. I mean, anytime you get something self-managed, it's very rare that they're doing good of a job as a best-in-class management company in that area will do. So like that's number one right there. And then the other thing is to create that community environment so that people want to call it home and like live there for 20 years. And the thing is, if you can create if you can create a community environment to where they know their neighbors, you coordinate things at the community so that you strengthen that, more like a family and like I say, a community, people will stay even as we bump the rents to market.
That's exactly right. And we've had a lot of success doing tenant referral programs on other properties. And at first you would think tenant referral program, so you're paying the tenants. Well, it pans out tremendously, because if you get good tenants in a property, and then one of your biggest costs is turnover, and then you get those good tenants come in there and they refer their friends and actually get paid to refer other good friends to come in there and live. Well, you start having your friends living there and you start having a community there. Well, they're going to stay longer. So not only do you have a better community because you have better people living there, now you also have people staying longer. So you're avoiding your biggest cost, which is turning units. And so that's very exciting promise. We're looking to put that back into play with this building right here. We do, I think, $250 tenant referral. But as we do, we'll transition and make sure we have the right tenant base in there, and just making this a better community for everybody. Yeah,
of course.
Awesome. What have we not covered? What else would you like to cover?
We talked about the market, the opportunity, some of the business plan, and why we partnered together. I don't know. I think that wraps up. I mean, as far as this project, now it's a matter of just executing and managing the managers. Although, as you know, they have a really good track record, so that's not something we're concerned about at all, which was one of the benefits to coming on board. Now it's a matter of executing the 10-year plan, if not, earlier, but execution, and make sure that the coaches are coaching that quarterback and we're taking it to the finish line.
Yep. And you're spot on, right? So we have a great management company there, but you want to have clarity with the management company, right? And I think one of the places people falter is that you're like, I have a management company, so I'm good. But if the management company, even if they're good or not, has no direction, and you're not giving them guidance or setting parameters for them, then ultimately they're just going to do their thing, and you probably aren't going to be happy with the result. It might not be the management company's fault, because you haven't really given them clear expectations. So for us, we have particular things in a turn that we expect of them. We have particular things that we want to be changed in every turn, particular way we want the unit to look. And that makes it very easy for them, because they can go in there, and so they don't have to go through a million different options and things they want to do for a turn and go back to us. They know these are our set parameters of what we're going to do for a turn. So they get in there and say, okay, hey, here's the cost for the turn. And we go through and we say, okay, yep, that's all the items we have in the checklist. It's very simple. And then on our point, there's no decision making. We don't have to worry about color choice. We don't have to worry about anything. We know exactly what we want each time we do a turn. So it makes it easy for the process from us, from a standpoint of being able to quick your decisions. And why this can be important is we just talked about turning a unit can be your most costly thing. Well, being vacant is very costly too, right? So if you're waiting for us to make a decision on color, and Dino, I'm like, hey, you like this fan? You don't like this fan? You want to put a light in? What are we doing here? Well, that's taking away money that you could be making right here by having that unit filled, especially in prime leasing season if you have people ready to move in. So right now we're trying to make sure, continue to just take our clear expectation from one property, translate it over. Everything is very, very simple to the bat. Keep it moving, and from this, we'll start continuing to get our investor updates out monthly, and we do a big updates quarterly all the way throughout the year. And that allows us to keep our partners informed on the opportunity, of course, what's going right, what we're continually working on to make better, and what's going to be action plan going forward for the next few months or a particular year in hand. And so a lot of it's going to be just on really maintenance and construction right now. And that's fine, because that happens a lot, and a lot of the heavies happen in the beginning, and there can be a lot of moving parts, because not only are we happening to take on renovations, but we're going to be now working on processes for applications, collections, and then any rent bumps or unit turnovers, because with anything that happens in the beginning, you of course will have tenant turnover, because some tenants are very excited to see change, and just like anything in the world, some people are not excited to see change.
Yeah, and I think another thing, just to touch base on real quick, is the loan structure, because there's so much, so much talk out there saying, should I be buying now? Should I not be? For me, the answer is, if you're B and C and you're looking to provide safe, affordable workforce, working class housing, the answer is yes, especially when you can, like the loan on this one, for example. So there's not a big giant balloon. We've got it locked for a long time. We can actually probably ride out another market cycle with this. And furthermore, the debt coverage ratio is in the right place. So even if we're fully occupied, and because of the market, we've got to bring the rents down a little bit, we're still going to cash flow. We're still going to be able to pay the loan. We don't have a balloon. It's like we're safe. So if you finance right, you don't over leverage. And again, you're providing that B, C workforce housing. That is Maslow's hierarchy of need states we need shelter. That's what we're providing, a basic human need. So when, what happened in 7, 8, and 9, when people got in trouble, if they were underwater with the house and had to relocate and sell, if they didn't have a family member in this new area, they moved into B and C workforce housing. And the people who were living in the A and just experiencing the luxury, who were paid more than a mortgage, they came down to the B and possibly C. So I think we see an increase in occupancy, even if we had to lower the rent, and we're going to be fine.
Yeah, and I absolutely agree. And being so under market compared to comparable properties, we only have upside, right? And so for this, the tenants, if they move, they're not going to be able to find comparable 2 bedrooms, which we all are, within the immediate area. But you're spot on, right? We took on longer term debt with fixed interest because we don't want to be forced to be in a position where we have to sell or have to make a decision that's maybe not right for our vision or our investors, based on being at a poor time in the cycle right now. So being that we are quote unquote at the top of a cycle, I don't know. I'm not a wizard, but on that point, over 10 years, a lot can change, and we have plenty of time to make good decisions over those 10 years. Well, good. I think that's a great recap of just takeover of the property. Look forward to doing this again in a few months, and we'll dive into where's the nitty gritties, what's gone right, what's gone wrong, and what we're doing to fix it overall.
Yes.
That's perfect. Well, Dino Pierce of Edified Equity, thank you so much for coming on with us today. Yeah, thank you. And appreciate the opportunity you and Kevin provide. So I'm excited to, like I said before, now it's time to execute, and let's have some fun doing it. That's awesome. Well, good. Dino, thank you so much. And to everyone out there listening, thank you so much for tuning in today to another edition of the Real Estate Investing Foundation podcast. It is Multifamily Monday, which I almost stuttered over, but it is Multifamily Monday. So that's why we just covered all things multifamily. And again, thank you, Dino Pierce. Awesome talking with you. Check it out. Bye now. Okay, bye.
Thanks for tuning into the REI Foundation podcast. Check back next time for more awesome tips and strategies to launch your new you in real estate.